Hey there. So you've got your money tucked away in a fixed deposit, watching that interest grow, right? But what if I told you that you might not be getting all of it? Yeah, there's a simple, totally legit way to make sure every single rupee you earn lands right back in your pocket instead of getting snagged for taxes. Let's break down how you can do just that. You work hard to save your money, and when it earns interest, you expect that to be yours. But, there might be a kind of hidden deduction happening, taking a slice of your earnings before you even get a chance to see them. It's super common, but the good news is you can absolutely fix it. So let's just ask it straight up. Is your bank taking a cut of your FD interest? Well, the answer is probably yes. And don't worry, it's all legal. It's something called tax deducted at source, or TDS for short. But here's the key part. If you meet certain conditions, you can put a stop to it. Okay, here's the magic number you need to remember: 40,000 rupees. If the interest you earn in a year goes over this amount, banks are actually required by law to deduct tax. Now there's a little bonus for senior citizens. For them, that limit is higher, at 50,000 rupees. So what is this deduction? It's called TDS, which stands for tax deducted at source. The easiest way to think about it is like an advance payment on your taxes. Instead of you having to figure it out and pay later, the bank just takes it out of your interest income directly and sends it off to the government on your behalf. Right, so how do you stop this from happening, especially if you know your total income isn't even high enough to be taxed? Well, allow me to introduce you to your new best friends, Forms 15G and 15H. These are your official tools to stop TDS in its tracks. At their core, these forms are basically a formal heads-up to your bank. When you submit one, you're officially declaring, hey, my total income for the year is actually below the taxable limit. It's your way of saying, please don't deduct any tax because I won't owe any in the end. So which form do you need? It's really simple. If you're under 60 years old, you'll be using Form 15G. And if you're a senior citizen that's 60 or older, then Form 15H is the one for you. They both do the exact same thing, just for different age groups. Now, this is the most important rule of all, so listen up. To be eligible, your total estimated income for the whole year has to be less than the basic tax exemption limit. For the 2023-24 financial year, for example, that was 2.5 lakh rupees under the old regime and 3 lakh under the new one. If your income is higher than that, then sorry, these forms won't work for you.
Okay, so now you know what these forms are and who can use them. But why should you really bother submitting them? Let's talk about the key benefits, because they're pretty great.
The perks here are super practical. First off, you get to keep 100% of your interest right away, which is a nice boost to your cash flow. Second, you get to avoid the whole headache of filing a tax return just to get that money back. And finally, your money can just keep growing without any of those pesky tax deductions slowing it down.
All right, you're convinced. You're ready to do this. But when's the right time to submit the form, and what actually happens after you do? Timing is pretty key here, so let's get into the nitty-gritty.
The absolute best time to submit your form is right at the start of the financial year, so in April. That way, you prevent any TDS from being deducted from day one. But hey, if you miss that, no biggie. You can still submit it later in the year to stop any more deductions. Just remember, the form is only good for one financial year. You've got to submit a new one every single year.
So what happens once you hit submit? Well, your bank takes a look, verifies all your details, and makes sure you're eligible. Once they give it the thumbs up, that's it. They stop deducting TDS from your interest for the rest of that financial year. Simple as that. And to put it in their own words, the goal is to prevent the deduction of tax deducted at source and avoid the hassle of filing for TDS refunds later. I mean, who wouldn't want to avoid a hassle, right? This whole process puts you back in the driver's seat with your own money.
So the main takeaway here is really simple. Spending just a few minutes online can protect your earnings for an entire year. It is such a small bit of effort for a pretty significant reward, getting to keep all the money you've rightfully earned.
And that really brings us to the final question. Now that you know exactly how this works and you see how easy it is, are you ready to take 5 minutes and go claim 100% of your interest income?